Welcome to a very special episode of Beyond the Deal. We are out on the range today. We're going to call this, I think, 9 questions, 9 holes. We're going to try and intersperse some golf content here and talk about real estate. So without further ado, let's get into it.
Here we go, guys. Let's go hit some balls and make sure the sound works.
All right. So while we're waiting to tee off, let's ask the first question. And the question is market pulse. So Mike, what is the biggest shift you're seeing right now in the markets? It's currently late Q3 2025. How are operators adapting? What's changing at the moment?
Absolutely. So what we're seeing primarily in, most of our properties in the Southwest, as you know, most operators right now are struggling with occupancy. And it's really two fronts. One coming from a lot of new product hitting some of these big markets in Texas and Phoenix. But the other challenge is so occupancy being there's a lot of folks either migrating, consolidating housing. So there's an impact of either recession. So what we're seeing is higher vacancy. Well, what are we doing about it? We're really looking at our numbers, right? What can we do to boost income? What can we do to attract tenants and bring them into our property? So the B and C class assets are really challenged right now. And if operators can adapt and bring in, some kind of concession, some kind of amenities to separate themselves from the competition, that's really going to hopefully help you stand out.
Yeah. And something I think cannot be understated is that, despite, whatever political climate we are in right now, our properties are being significantly impacted by the ICE raids. We have workforce housing, largely Hispanic communities, and these ICE raids are actually scaring away potential tenants. You have any thoughts?
No, man, we're going to go hit a couple holes. So let's go see. All right, I'm left.
We smashed the first shot, 30 yards to the pin. It's going to be a good day. Never mind. I didn't know there was one directly behind the pin. So not a great day.
Second question, Michael. Got the sun bearing down my face here. But asset class headwinds. So, multifamily has been the place to be for so long. Where do you think it is now? And what do you think some of the other asset classes are that are going to be really good for the next couple of years?
Yeah, so you're right about multifamily. I mean, right now, when you have maybe a 6% top cash flow and a 6% interest rate and a 6% cap rate, there's no money to be made right now, at least if you're doing deals the traditional way. I think if you're going to find a multifamily deal that works right now, it has to be direct to seller, probably owner financing, some sort of creative element that actually allows you. Because if the banks are involved, there's just really, really no way you're going to make money. I think with our new boutique hotel deal, that's really a space that I find very exciting right now because it's very niche and it's where people are going. People are spending more money today on experiences than things. They find out about things through Instagram. So we hire influencers, we attract attention, and they're very into the whole sort of wellness, cold plunge sauna. And we're kind of going into that whole angle. So I think that's definitely a direction where there is money to be made. I also think industrial is a really, promising asset class for the future. Retail is doing all right, provided you have some strong core tenants and you have the kind of things that people want to go to.
Awesome. Great stuff. Oh, I hit that so good.
All right. So question number 3, first time capital raisers. If somebody has never raised capital before, what sort of things should they start doing right now to prepare themselves for the first time they need to raise money?
Yeah, great question, Michael. I think a couple things. First of all, if you're understanding who your investors are, how do they know you, right? If it's somebody in your network or people in your network, how do they know you? And then how are they going to know you now as a capital raiser? So you're changing hats. And so you really need to understand the vernacular, the language of it. Let's assume we're talking about real estate and let's assume we're talking about multifamily. Get to know that language. It's a totally different world. You're now putting on a different hat and talking to that same person that maybe you've known for 10 years, but now you're talking about raising capital from them on a real estate deal, which maybe you don't have expertise. So whoever you're working with, that partner that knows the deal, that expert, be a shadow to them and, learn the business so that you can articulate how that deal makes sense for this particular investor.
Yeah, that's exactly right. You really can't get into this industry without somebody else lending you their credibility in the beginning. Because if you've never bought a 100-unit apartment before, why would your friends and family be like, that guy knows what he's doing, right? So you have to actually have a sponsor to get into your first deal. And you basically use their resume as your resume. But most of the time you're going to be raising from friends and family for the first time. That's your immediate circle, your close network, maybe your coworkers, whatever. You need to be able to articulate, how the deal's going to work, how they're going to get paid, what is the vernacular, exactly like you said, and, all of these things that lend trust and credibility to yourself in order to get the first deal done.
Yeah, 100%. Boom.
We both rolled off the green, so we have some really long putts for birdie here. Probably not going to make them.
Michael, we got a lot of technology. It's the world of AI. How do you see AI and tech impacting how operators like us, communicate with investors, run deals? Like, tell me about how we can impact the business.
Yeah. So for our last capital raise, actually for the very first time, we used an AI bot. We trained a text bot on how to answer questions specifically about our deal so that if anybody texted our business line, immediately they would get a response from the AI agent. And it was surprisingly effective, kind of in a way it does the work of an SDR where it knows the deal and its goal is to set up a call with me. I will say it's not a perfect system. It was very aggressive sometimes. And, people will have mixed reactions when they realize they're speaking to AI. Some people will be fine with it. Some people are not ready for that yet. But, I'd say we got probably 2 investors out of it, at least 2 calls set up specifically because of this AI bot. So it has utility, and I think we'll keep refining that process in the future.
Yeah, I was gonna say, let's keep going on that. So what I wanted to add to that is I just got a sales call from an AI bot on a sign request. So we're doing a project, needed a sign. I filled out the questionnaire online, got a phone call almost immediately, and I did not know it was AI for the first little bit. It was very impressive. Ran through the script, so got the voice, had the energy of a human. It was really, really impressive, and I engaged and I got a quote. So it's really evolved from even what we did last year on that last raise.
Yeah, we know I'm capable, but aim is a problem.
Aiming is overrated. All right.
All right, next question. So let's talk a little bit about debt. So with interest rates where they are right now, what do you think is the best way to be approaching debt, refinancing, restructuring debt, all these kinds of things?
Yeah, it's super tricky right now. Obviously, a lot of lenders are being very, really conservative. So when we're looking at deals, obviously, like you mentioned before, we're really looking for seller financing if we can. It's going to be low leverage, guys. So if you're looking at a deal where before maybe you can get 70 to 75% LTV or LTC, it's going to be in the 60s. So you really need to get better at underwriting to make sure that deal pencils, like you talked about. Cap rates are high, interest rates are high. We're talking about most commercial deals are going to be in the 6s. Maybe you get something with a high 5 handle, but it's going to be really tight. So I think just thinking about long-term play, we are all about cash flow. So if this deal doesn't pencil at 7, 8, 9% cash flow, almost an acquisition, it's just not a buy for us.
Yeah, that's exactly right. It's very, very hard to find deals that cash flow right now with interest rates where they are. So if you can, go for the seller finance.
Yeah.
Short par 3, 130 yards. Mike's about to get his first hole in one right now.
A little long. Oh, we're on. And a roll to the fringe. All right, I'll take it.
All right, next question. So from an operational perspective, an asset management perspective, what are some of the biggest levers that you think an operator can pull, whether it's multifamily or another asset class, but these sort of fine-tuned asset management things that really make a difference in NOI?
100%. I mean, I'll zoom out for a second and talk about the tenant experience. Tenants have a lot of choices these days. As we talked about earlier on, there's a lot of vacancy in the marketplace. So really focusing on the customer experience. We call it renewals in the multifamily world, right? Because basically every 6 to 12 months, these guys have an opportunity to leave. And so what can we do to keep them in place? What are some amenities that maybe we need to offer? What are some just conversations? Our PM in New Mexico is amazing, right? She's always focusing on what does that tenant need? And sometimes it's as simple as, we can raise the rent $50, but that tenant really could use a new ceiling fan or some new blinds. What does that cost us? $50, right? So just in 1 month, we're already ahead, and it saves us a ton of time. If that tenant decides to move out, we're spending a few $1,000s, right? At least to be able to clean that unit up, possibly have to put carpet down. So now that tenant stays, we get continued income, slightly higher, and we have a happy tenant.
Yeah, that's 100% right. I mean, the difference between getting a renewal at even $10 higher and not losing that vacancy, $10 an extra per month versus 2 to 3 grand that you'd have to spend minus, the month or two that it might sit vacant. Keeping your tenants happy, providing a really good tenant experience is everything in the NOI game.
That's right. And on the tenant side, there's cost to them too, right? It costs money to move. It can cost $500 to $1,000 to move. So sometimes that little bit of rent increase. And right now we're getting a lot of pressures where some of our deals we're not increasing rent.
Right.
We're still offering some of those
Concessions
to get them in because, again, occupancy is the name of the game. Michael says no tease. We're just going for it. Oh, smooth, crispy. Going a little left.
In the
We're
sand.
looking good.
Hey, really quick, thank you for watching this episode. I wanted to interrupt for just a second to let you know that if you have ever considered raising capital for real estate deals like I do, my course is now on sale for just $250. That's right, lifetime access for just $250. You get access to all the scripts, all the processes, all the tech, all the marketing. I will teach you everything you need to know in my video course. You can use the link below to check it out. You can hear testimonials from other students. Most of my students are raising an average of 500,000 in their first few months. Some of them have raised 1.5 million. All right, so if you've ever considered doing this, go ahead and click the link below. And if you are interested in one-on-one coaching, that is also something that we can talk about. You can book a call with me. All right, let's get back to the episode.
Michael, let's talk a little bit about investors. What kind of marketing activities and strategies do you have for attracting new investors?
Yeah. So in the beginning, you're probably not going to have the budget to be spending on ads, but that really is one of the absolute best ways to find new investors, particularly Meta Facebook ads, especially if you have a 506c deal. You set a budget, you run some advertisements for it, you collect the leads, put them into your CRM. But in the beginning, it's going to be a lot more word of mouth. You have a network of people already, friends, family, coworkers who know you, they trust you, right? So you need to start telling them exactly what you're trying to do, exactly what kind of asset class you're going to buy, how much money you're looking to raise from them. And then you ask those people for referrals. So you start expanding your network, you start collecting leads, you start creating a database of leads, and then you have to start marketing to that database. So there's going to be email campaigns, text campaigns. You can create a lead magnet, like an ebook or something to offer specific information. You can go to a lot of networking meetups, like real estate meetups. That's a great place. I would join your local real estate investor association and go to those meetups. There's also meetup.com has a lot of local meetups. There's really an endless supply of things that you have to do, but not all of them are going to work for you. And some of them are going to work better than others. For us, Facebook ads was really the way that we were able to build a database of thousands of leads. But, for you, I would say start local, start going to places that you can meet other like-minded people who are interested in investing in real estate.
That's right. Great work.
140, got the bunker right in front of the hole.
All right, here we go. There you go. Gonna get a little bounce.
Over. All right, Mike. So since you're in the sand trap over here, why don't we ask you a quick question about market conditions, right? So what are investors and operators going to have to do now until something changes in the market? How has exit strategies changed?
Yeah, so it definitely feels like, just like my ball here is in the trap, it's a tough time. Cap rates have definitely expanded. Operators are getting squeezed. If you're in a position to sell, like we have a deal, we're 4.5 years in, we're ready to sell. We actually could. The climate isn't perfect to get the best price. Thank goodness for us, we've kept occupancy up. We have a good NOI, and we're just applying that to a slightly higher cap rate. And so for us, we can do the math and it looks good for investors. Investors would definitely appreciate their capital back and some appreciation. If we held on to it for another year, we could do that and see where interest rates go. Most likely that's going to drive a little bit more demand and likely a better price a year from now. So it really depends on your capital needs, your investors' kind of appetite for getting out, hopefully reinvesting with you.
Can he get on the island?
Come on. All right. On.
All right. So we've lost track of the questions because it's starting to get really hot. It is still summer in Arizona, but we'll pick it up wherever. Mike, We are actually right after this going down to our property in Casa Grande, which is a retail commercial deal. Can you tell me a little bit about sort of the theory behind why retail centers work and why they're still a good investment bet in 2025?
Absolutely. So, obviously our first venture into retail, and, it's a little scary because, it's different dynamics. There's different market demands in those spaces. So if you can do the homework first, I would say it's very sub-market specific, obviously category specific. So we're doing a retail block of entertainment and dining. If you did the homework down in specifically in our market, we knew there was a huge gap for that type of asset class or that type of operator. It was the tough part is just attracting those types of folks. But retail triple net is great for the landlord because your tenants essentially pay for all of your operating costs, which is very different than multifamily where we're paying taxes, insurance, maintenance. Your tenant is paying for the majority of all those things, and you're doing a little bit of common area maintenance. So from a cash flow standpoint, if you pick the right kind of operator, long-term leases too, that's another big benefit that we had is we're getting 5, 7, and 10-year leases on our deals where we're not ideally having to turn anything every year. There you go. Get up. Get past the rocks. All right, Michael. So as we're wrapping up hole 18, we're getting close to the end of 2025. What's it going to take for you to get into another deal? What's the thing that's got to really get you excited?
Yeah, and we're being chased by this landscaper right now. Hopefully the audio isn't too messed up. But in 2025 right now, I probably would not do another multifamily deal unless it had owner financing and something like 8 to 10% cash flow for the investors on day one. For a lot of the last few years, people kind of went through this mindset of, well, the deal's tight, but the market is good. We can buy it. It'll cash flow 6 or 7%. I wouldn't touch anything like that right now. In fact, if a bank is involved, I'm probably very not interested in the deal. Banks are the worst. They just make everything so much more difficult, and they're going to be the ones who end up making all the money, not you. So in order to get into a new deal right now, I'm looking for at least 10% cash on cash and owner financing.
Yeah, perfect. Going up to our hole 18, I think it's like 350. Michael almost drove the green.
Drove the green.
It's like 30, 40 yards out. So Nice work, man.
So we just finished up, had a chance for birdie, got a bogey. It's called golfing, everybody.
It's called the birdie to bogey program.
So a little bonus footage. We're down in Casa Grande now, potentially looking at materials, meeting with the landscaper, checking on some pavers. We're going to head over to our retail property and show you a little bit about what that looks like right now.
What's going on, guys? We're here at the terminal. You guys can see here we're at Core Therapy. So we showed them some video of the glass. This is going to get a really nice wood paneling texture all the way around. And then we're going to paint that side over there. So it's going to look all nice and uniform.
See the outline of the bar. It's going to be a really badass cocktail bar, gastropub. That schematics that you saw in the last video is everything that's going to be behind me right now. Doesn't look like much, just a big old dirt lot. But you can see there's Core Therapy. That's our warehouse. So this suite is completely framed out. We've given them their keys already. As you can see, it's going to be salon suite. So this is Dulce Beauty. And they are pretty much ready to move in. We're just waiting to get certificate of occupancy.
This suite is totally enclosed interior suite, which you would think might make it tougher to get a tenant, but we've actually been in touch with some indoor golf simulators who really want this space. So I think that will work out nicely.
This is our warehouse space. Really want a brewery to come occupy this, like a taproom brewery. But wedding venue could be great. Been even looking at some sort of indoor sports franchises.
huge warehouse, could be so many things. Leads right into our patio area, which you saw the design for earlier. So that's all going to be really nice done up. There's going to be a stage, dog park area. This is the back patio for pour therapy.
That's a wrap for today's episode of Beyond the Deal. I hope you got some valuable insights that you can apply to your own investing journey. Now, if you've enjoyed this conversation, do me a favor, hit that follow button, leave a review, and share this episode with somebody who you think could benefit from it. It really helps the show grow and bring on even more incredible guests. If you want to go deeper, make sure to follow me on your socials. You can find the links in the show notes in the description below. Thanks for tuning in, and I'll catch you next time. Until then, keep going beyond the deal.